Howdy, welcome. Good morning, everyone. My name is Ashwin. I'm the student lead of operations here at Genesis. Genesis is a student alumni organization that seeks to unlock the potential of student entrepreneurs all across campus. Today, along with the Herb Kelleher Center for Entrepreneurship, we are so excited to have Mr. Scott Kupor, the managing partner of Andreessen Horowitz, the #1 VC firm for tech in the world. Before we invite Scott on stage, I'd like to invite Nick Spiller, the Director of Marketing and Events at Genesis, to say a few words about what we're doing here on campus.
Howdy, can you all hear me? Is that too loud? Won't talk too loud. Welcome. It's so good to see you all. A lot of old friends here. It's actually quite astonishing to think about how far we've come. We've talked a lot about it with Scott. The changes in Austin, the changes on campus over the last 10 years. It's really exciting. And I think specifically something that stuck out the last few days has been it's like you don't need to leave Austin when you graduate anymore. And it's you have every major tech company, you have a thriving startup ecosystem right downtown, and you can start developing your career in that while you're in campus, and you can stay here. And I think that's pretty special, and I was lucky to be able to stay here when I graduated, but when I graduated, that was not the case, and a lot of people had to go to other cities like San Francisco, New York, Dallas to experience it. But if you're like me, you really like Austin, and that's an awesome piece of it. Sorry, we're at the wrong side of my deck. So Genesis, we are UT's first startup fund. We live inside the university. We're an alumni student joint venture, so alumni who work in venture capital and entrepreneurship, support and collaborate with student investors who are on campus that I'm sure a lot of you have met before. Really, the purpose of Genesis, like Ashwin alluded to, is to really unlock the full potential of UT students. And we use venture capital and entrepreneurship as a model to do that, and we believe it's been proven as a very efficient way for us to experiment and test our ideas and ultimately go on to do what we're all here to do, which is change the world. We're at a really special place. UT Austin is very unique. It kind of has the best of both worlds in our sense, and we have highly trained and regarded faculty and research institutions. We have smart students. We're in an entrepreneurial, innovative environment, but we're also really big. We're one of the top 5 or 10 largest universities in the country, and that's really, really powerful. We have thousands of students that come every year and graduate every year, highly trained, ready to change the world, and that's not, it's very rare to find a large school with that high caliber, and so we're very special in that. We believe that's why Genesis will thrive, and that's why we believe that the community will thrive. And we actually did some research, and there's been a lot of companies started by UT Austin alumni, and I'm sure you guys know a lot of them. Dell is the famous example, but there's countless examples, and we actually found that $8.8 billion of value is created by UT Austin companies every year, and so that's nothing to shy away from. So Genesis, we've been at it for about 4 years now. Really excited. We started with a small amount, about $50,000 that we raised, and we set out to really build on the shoulders of the rest of the startup ecosystem at UT. And so you're probably well aware that there's a countless amount of resources and programs for you as student entrepreneurs, as members of the university around campus, and really Genesis is leveraging that infrastructure to build our community, our portfolio. And so we apply venture capital to the student experience. And we've built a team that goes and We have a deal sourcing team who's tasked with knowing every student startup on campus and every entrepreneurial leader we have, and they bring the best ones to our due diligence team to perform an analysis on whether or not this could be a really, really big business. And if we believe it can be, we'll recommend to our funding committee that we invest in that student project, and typically those investments range between $5,000 and $15,000. So, which is really meaningful for an entrepreneur that might want to test a product or run some revenue or some advertising experiments, whatever it may be. And really what I think is most beautiful about the whole thing is it's the best way to learn. You get to pick what you learn. It's self-directed. You're not guided by anybody else, which to me makes it much more engaging. And once we invest, we don't stop. We've built a network of advisors and mentors and a collection of programs through which we connect you to very talented people that can help you build your business, other students who you could bring on as co-founders, and when you're ready, we'll help introduce you to later stage investors that you could raise more money from. We're very proud, and actually a handful of you in the room contributed to this, but Genesis ran the largest crowdfunding campaign in the university's history a couple years ago. We raised $1.2 million in 48 hours during that campaign, which is really exciting, and that was really our coming out party as well. And so very excited to have that endowment in place to where we'll for the foreseeable future have money to invest in student entrepreneurs. We have an awesome base of donors and alumni. Joshua Bayer from Capital Factory was our first donor. Brett Hurt. Jay Parikh is another incredible supporter we have. He was the co-founder of Sony Television, and the list goes on from there. And we even have deeper relationships with our advisory board, which includes Bob Metcalf, who invented the Ethernet, Rudy Garza, a venture capitalist and previous president of Texas X's, and like I mentioned, Jay Parikh as well. And UT Austin has this massive pipeline. I don't know if you realize this, but at any one time, there are hundreds of ideas that are just incubating all around you. And you can tap into this and be a part of it, and you can help make it successful and be the difference, and that's always around you on campus. And here on the screen you can see a handful of organizations which we encourage you to get involved in, find the thing that you're excited about, and really go push the needle with your peers. We've invested in over about 25 companies, and we're really proud of our portfolio. In a second you'll see one of our companies, Hitch, come up and present, but we've made a handful of investments, and we're going to continue to do that as well. So yeah, and really with Genesis, what we want to do is strengthen the virtuous cycle that entrepreneurship brings to the university itself. And it's no secret, if you look at the buildings around campus, the names on them are all entrepreneurs. And so we believe by creating a part of the university that embraces entrepreneurs early on, supports them, accelerates their success, that'll only lead to more successful entrepreneurs who come back, donate their time, donate their capital to invest in the future of the university. And really that's our big purpose. So without that, I'll stop talking. Again, thank you so much for being here. I'm just so thankful, especially for the people that have been helping us for years and years now build to this point. So thank you so much. Book Awards.
Thanks so much, Nick. And now I'm really excited to bring on Kush Singh, the CEO of one of our most successful startup companies, Hitch.
Thanks, Ashwin. I don't know if we're one of the most successful companies, but it's good to hear. There are a lot of great companies in the batch in the portfolio. So, but yeah, my name is Kush Singh. I'm the co-founder and CEO at Hitch. And Hitch really started with our complete dissatisfaction of the intercity travel industry, specifically in the 50 to 350 mile range. A couple of years ago, I used to live in Dallas, and I commuted frequently between Austin and Dallas using the horrid Megabus and Greyhound. And it was shocking to me on how passé and how bad that experience actually was. From the filthy pickup locations to the crammed-in bus, I'm sure you all have experienced at least once in your life that terrible time, and I hope to never experience it again. But during that time, I even explored other options, such as flying or driving myself. However, flying in this mile range is actually slower than driving yourself and costs 3 times as much. And driving is, although it's incredibly flexible and you can leave when you want to leave, the price of gas and also the time sink is just not worth it. And so, oops, I thought I clicked there. But so that's why we founded Hitch. We're connecting drivers headed to the same city with riders who are also going in a similar direction. Every time I would take the bus, I would look outside the window and notice all of the empty car seats that are going in between the 2 cities. And I dug in deeper to figure out how does the industry actually look like today. And it turns out that there are over 1.8 billion car rides that are going in between 2 cities every single year. And over 90% of these car rides only have 1 occupant in them, which is the driver, him or herself. And so this, every single year, leads to 3.2 billion unfilled car seats that are going in between 2 cities every single year. To put that into perspective, that's more empty car seats than the total seat capacity of buses, trains, and planes combined. We're trying to match these empty car seats with riders who are also headed in a similar direction and reduce the number of cars that are on the road, while also delivering a much better riding experience for riders and a much better driving experience for drivers, allowing them to monetize their rides. There's absolutely no scheduling or planning associated with Hitch. As a driver, this is a fantastic part of the actual experience. There's no posting or planning days or weeks in advance. On the day of your ride, you simply hop in your car, start driving towards your destination city, and if we can find passengers exactly along your route, we'll match you to them. You don't have to plan, and you don't have to drive out of your way. For riders, rides start at just $25, making it cheaper or comparable to the price of a bus ticket, and far cheaper than flying. And also, with many of these marketplaces that have started over the past decade, they've never had a guarantee. It's always been this sort of like Craigslist-like booking system where a driver's posting and a rider is trying to find a driver that's also going that direction. And the onus is all on the rider to find that ride. However, we make that far easier with Hitch, and we guarantee you rides. We've never missed a ride. Here's how it works. Riders and drivers both start in the same app and start by entering their final destination. They're then directed to the nearest pickup location, which, as I mentioned before, is exactly along the route of the path that they're traveling. And I want to emphasize, there's no additional driving for the driver. It's incredibly easy to use it. Finally, at the actual departure time, you'll get to meet your driver, similar to Uber, Lyft, and other rideshare services. And this is where we really, really crush the Megabus and the Greyhound, is with dynamic drop-offs. Because we know the final destination of all the riders in the car and the driver, we can real-time, similar to the Google Maps faster route available feature, figure out if there's a closer drop-off location available to you, making the last mile far cheaper and far easier. So far, we've operated between Austin and Houston and have done thousands of rides in between that one lane and onboard over 1,000 drivers. And we're super excited that on October 1, we're opening up Dallas and Austin as a route in my hometown, Dallas. We have a beautiful team working on it, and a wonderful team working on it, and beautiful. And we've, including the founders of UShip, which was I think the largest freight transportation marketplace in the world now, and a few fantastic and great early Uber employees. We've actually doubled in headcount since this, so we have over 15 people, and we'd love for you to join us as well. We're located right on 6th Street, right next to Easy Tiger. That's where our building is. You'll see our sign in the next week or two, and you can apply directly through hitch.net. And if you're not looking for an opportunity, or if you're looking for an opportunity, please download the app and try it today. Thank you.
Thanks so much, Kush. I've actually used Hitch twice myself and confirmed that it is a unique and wonderful experience. But now to our main event. So I'm excited to invite Andrea Kalmans on the stage. Andrea graduated with an MBA from the McCombs School of Business and went on to advise and invest in multiple wildly successful startups in the Austin area. She is both a serial investor at Capital Factory and a principal at Lantra Ventures. Please join me in welcoming Andrea to the stage. Great. Here it is.
We're getting this all worked out.
And now I'm excited to invite Scott Kupor on stage. Scott Kupor is a managing partner at Andreessen Horowitz. He has been with the firm since its inception in 2009 and has overseen its rapid growth from $300 million in assets under management to more than $10 billion. In addition, he is the chairman of the board of GenesisWorks, co-founder and co-director of the Stanford Venture Capital Directors College, the vice chair of the investment committee of St. Jude's Cancer Research Hospital, and a best-selling author of the new book, Secrets of Sand Hill Road, Venture Capital and How to Get It. Please join me in welcoming Scott Kupor to the stage. We hope you're inspired by today's conversation. If you're excited to engage with Genesis, check out our website, genesisut.com, or find a Genesis leader after the talk. Thanks so much.
Thank you. Oh, good.
You're ready.
It's absolutely perfect. Well, we have been having an absolutely fabulous couple of days here in Austin, and I'm so glad that you're here to talk to.
Thank you for having me.
Yes, of course. So we are sitting in a very esteemed place. We're in the McCombs School of Business at Rollins Hall and the Herb Kelleher Center, all of which were amazing entrepreneurs doing amazing things. And so we love to talk about the journey of what brings us here. Will you talk to us about your journey of how you came back to these 40 acres to tell your story?
Sure. So first of all, thank you for having me, and thanks for everybody at UT and at Capital Factory for supporting us the last couple days. My background was a little bit of a circuitous path. So I grew up in Houston, and so it's nice to be at least somewhat close to home.
Yes.
And ended up out west at Stanford, and was lucky enough to be there at a very, very interesting time for the market. So if you guys remember your kind of history of the internet, basically, you've got kind of major seminal events like Netscape going public, for example, in 1995, which was kind of right in the middle of my time when I was at school. So it was a fun place to be. I decided, or at least I thought I wanted to be a lawyer, and just went to law school, and then decided about halfway through that was not the path that I was most interested in. And so for those of you who are considering graduate programs, one piece of advice is actually, figure out if you actually want to practice in the areas that you're studying before you go do that. It's
Absolutely, good advice.
Always good advice to avoid spending time on things that don't have long-term consequences for you. But what happened as a result was I just happened to be in the Valley at a very good time. We were going into this market where there were just crazy numbers of IPOs happening, right up until the world seemed to be perfect. And of course, at the middle of 2000, actually, it turns out, if you remember your history, that, NASDAQ peaks at 5,000, and we don't realize that, it's basically going to go all the way down to 1,000. We're going to lose 80% of the value in the technology industry over that period of time. But it gave me an opportunity to kind of get introduced to a company that was getting started at the time called LoudCloud. And through that process, kind of got lots of interesting operational experiences in kind of being part of a startup. And then was lucky enough in 2008 when Mark Andreessen and Ben Horowitz decided to start this firm to be able to kind of go along for the journey. And it's been now a little bit more than 10 years of being in the venture business.
One of the most interesting things about that story to me, thinking about your shoes, and I remember being in your shoes, the 18 to 22-year-old time in your life, is you probably where did you think you were going to be? Did you ever think you were going to be here?
No, I had no idea. And I think, look, I think I get a chance to see a lot of students, and spend time with students. And look, we all kind of live in this very linear world from kind of ages 0 to 21 or 22, right, basically, right?
I was so good in those years,
right.
Just knocking out the A's.
Exactly, right. And everything's very linear and it's very progressive, right? Exactly. You know exactly what you need to do. The goal is, do well in your studies, and you get promoted to the next grade, and you get to go to great, institutions like University of Texas. The sad truth of it is, though, it has bears little resemblance to what actually happens once you actually get out into the real world, which is, number one, things are team sports, not individual sports for the most part. And also, there is no such thing as for the most part, a linear path. There are some professions, obviously, that have that, but, I just encourage people as I talk to them to think about, you're laying the groundwork for what has been a very traditional linear path. You will likely end up in a more circuitous path over time, and part of, I think, taking advantage of opportunity is leaving yourself open to, things that are serendipitous and that, come your way, and, evaluating whether it makes sense to get off the path potentially to go do something different at times.
I just allowed myself to do that in the last, 6-7 years when I started venture investing, and I think that's really when the best part of my life really started. So you, Ben, and Mark, how did you meet them? I mean, did you know when you met them this was going to be a 20-year, for the rest of your life relationship? It's very interesting that you met them and have worked with them for so many decades.
So I met them in September of 1999, which was exactly when they started LoudCloud, and actually met Mark before I met Ben. And as I said, I got this serendipitous introduction to them from, a company I had taken public when I was a banker who quit to go join the startup. And I'll never forget, I had this, phenomenal interview with Mark at, of all places, a Denny's restaurant in Sunnyvale, California.
It's a nice chain.
Exactly, right. So if anybody's ever been to Northern California, if you know Sunnyvale also, Denny's in Sunnyvale is the perfect, symbiosis, basically, which is Sunnyvale is this very unimpressive, more industrial part of the Bay Area. It's not what you would imagine on the postcards when you see the Golden Gate Bridge and things of that sort. But, he scribbled on this napkin about how, they were going to take over the world with this company, LoudCloud, and I was just so smitten with the idea and with the prospect of being part of something that could really have a major impact on it. And I went home that day to my wife and told her, look, I'm thinking about quitting my job to go do this, and rightly so, she looked at me like I had 3 heads. She was about 4 months pregnant at the time, and we had just bought a house, and she's like, look, this is the craziest, stupidest thing ever to do. Like, why would you quit your job in order to go do something that has, some reasonable prospect of never actually going anywhere. But it was just what I said at the time, I said, look, I don't know if it'll be successful or not, but I know it's going to be super fascinating and interesting from a professional perspective. And, at the time, at least, we were comfortable taking that risk. And so, I didn't expect it would ever be 20 years, but, I think to me, what it does illustrate is, I think a lot of, again, as you think about your professional life, a lot of your professional life is hopefully, doing, A+ work in terms of the work that you're entitled to, but also spending time building relationships and broadening out your set of networks. And you just never know when, way leads on to way, and you may find yourself in a situation where one of those networks and one of those relationships bears fruit down the line in some other area, and I was lucky enough to just take advantage of that.
Key takeaway, when invited to Denny's, take it seriously.
Right, exactly.
Let's talk about the concept of black box.
Yeah.
So the venture industry, to many of us, can seem mysterious. And you talk a lot about this concept of sort of a black box, and that's why I love the book, especially the way you lay out a term sheet and the way you lay out, just things that to you may seem basic now at this point because you've done so many deals.
Sure.
What is sort of the message that you want for people to understand with the black box about how the industry works?
Yeah, I think, the reason to write the book was I think this industry has been probably, it's been too much of a black box. It's been too opaque for a long period of time. And I think it's unnecessary. And what it does is it creates tension where I think tension doesn't need to exist between venture capitalists and entrepreneurs, right? And so there's always this underlying, concern, and I hear it all the time from entrepreneurs about, gee, am I going to get taken advantage of? Am I going to get screwed by the venture capitalists, or whatever the term of the day might be? And I think a lot of that goes to just foundational issues, as you mentioned, which is, we're repeat players in this game, right? So we've been around for 10 years. We probably see a couple thousand deals a year. We probably do, 20 to 30 deals a year. So over the course of our professional career, we will just have many more at-bats at this game. And therefore, we will be more conversant in the terms of how things work and, what works, what doesn't. And look, a great entrepreneur who is successful over time might do this 3, 5, 6 times or something. And so the whole theory behind the book was, look, could we take what is a black box and, open the lid, hopefully expose it in a way that, encourages more what I would call a symbiotic relationship between the venture capitalists and the entrepreneurs. Because at the end of the day, we both share the same fundamental objective, which is we both are interested in doing what we're doing because we think there's an opportunity to build really interesting, incredibly important, hopefully over time valuable and long-lasting companies. And so it just needlessly complicates the relationship if you get that relationship off, on a foot where you feel like somebody knows something that you don't, and therefore they might have kind of, a leg up on you.
Yeah, no, and I found the book particularly interesting. So when 1998 to 2000, when I worked at Solomon Smith Barney and we were doing IPOs, I used to sit in the table and, write the S1s.
Yep.
But I only knew a fraction of the process.
Right.
And now I know the seed investing part, and through some of my portfolio companies, I'm learning about acquisitions and next rounds and those things. But to have the exposure to the entire life cycle, it's like you only know how to raise a kid after they're gone. So if you had known.
Right,
and
right.
I think that's just, I love that idea of understanding all of the different components. And I think that between you and Brad Feld and some of the YC and Techstars, we've created so much more transparency into an industry that's allowing us.
I appreciate that. Thank you.
Yeah. So the thing that I love about the book, because I don't always think this way, is the VC criteria. You talk a ton about market size.
Right.
And, and I don't know, as an angel investor, I don't necessarily have to have a $100 billion exit, although I would love it. I mean, will you talk about some of your VC criteria, particularly you talk about product market fit and market size?
Sure. Yeah, so let me go back before I do that. Let me just kind of explain in hopefully 30 seconds or less, how does this business work? So the basic way to think about the venture business is we are wrong more often than we're right, and it turns out that the difference between success and failure of this business is not based upon your actual raw score, but it's based upon the magnitude of your winners. So let me just give you a very simple example, right? So probably between a third and half of what we do, we will lose all of our money on, and we very politely say that we have impaired capital, which basically means you screwed up and
I love that expression, by the way.
lost your money.
Walter, we have impaired capital.
Right, if you have impaired capital, right? But, it's crazy when you think about it, right? You can imagine, right, for any of you who are students here, of course, if you came home and showed your parents your report card, and if a third to half the time you failed, they probably wouldn't be that happy about paying your tuition the next semester. So that's basically how this business works. You kind of lose your money most of the time, or at least a lot of the time. You make a little bit of money some of the time, and then it turns out that the difference between successful and not successful venture firms are what happens in that last 10 to 20%. Do you have a Facebook? Do you have a Lyft or an Instacart or a Pinterest or something where you're earning kind of very, very high multiples on your money to basically subsidize the losses? So that's kind of the framework for how to think about this business. And so again, it turns out that it doesn't matter, the analogy I use in the book is kind of to baseball. In baseball, your batting average, right, would be equivalent to, what happens here, which is we're wrong half the time. It's interesting. What matters more is what is the equivalent in baseball would be your slugging percentage, which is when you get a hit, how many times do you get an extra base hit or a home run, hopefully, right? And that's really what we're trying to go for. So if you start with that, then, kind of as Andrea said, what that means is the first criteria to think about from a venture capital perspective is what's the likelihood this company could be in that upper right quadrant of one of those 10 to 20% of my companies that could return, of the scale of a Facebook. And so that leads you initially to market size, to say, okay, look, there's nothing normative about going after big markets, but it's just as hard to build a small company as it is to build a big company. And so are you going after a market that's big enough to sustain a company that can ultimately make it into that, quadrant? And so there's no magic to it, but, the way I would think about it is to be a public company today, you probably have to have a couple $1 billion market capitalization, which means probably, you have to be able to generate at least $300, $500 million of revenue and still be growing at a very, very rapid clip at that scale, probably still growing 35 to 50% a year in order to be an attractive multi-billion dollar market capitalization at some point in time. So that's kind of, how we think about market size. Now, as we can talk about more, market size is a little bit, it's easier sometimes to figure out than it is others, right? So sometimes it's very obvious, which is you have an existing product in an existing market and you're doing something that hopefully is, just a lot better than what the current state of play is. Those are easy markets to estimate because we know that they exist. So a great example would be, if you're going to propose to build a new database company, we know what the size of the database market is, right? There's been companies like Oracle and others out there for a long time. It's not that hard. And so the question is really not the size of market. It's, is your thing kind of good enough and better enough to cause people to switch and ultimately want to try your product? But you look at a market like a Lyft, for example, or you look at an Airbnb, you know, that we were lucky enough to be investors in, and at the time you look at those companies, the markets don't exist, right? In other words, you know, you look for proxies, but those proxies are often wrong.
That's what I find so amazing, to be able to see that story that the entrepreneur is building up for you.
Yeah, the example, you know, I like to give, I talked about this last night, but, you know, at Lyft, if you looked at Lyft when they first raised money, Lyft and Uber, you know, kind of raised money about the same times, the total size of the San Francisco taxi market was about $100 million. That was how much taxi revenue that was happening every year in San Francisco. And a lot of people looked at that and said, okay, that's an interesting market, so if they capture some share of the taxi market, it's okay, but like that's not that big of a market. You know, obviously, you know, $100 million, nobody should you know, sneeze at that, but it's just, you know, in the scheme of venture capital, that's not that big of a market, right? But, you know, it's interesting to say, if you fast forward to the time the two of them went public, the size that just Uber and Lyft do in San Francisco was a combined roughly $1.5 billion, right? So you're talking about a market that over time grew almost 15x over probably a 7-year period because the introduction of technology created a new market that just didn't exist before. And so much of kind of, you know, our job, and really, quite frankly, it's a big job of the entrepreneurs, is to help position us around market size and opportunities where the technology can meaningfully grow the market by just, you know, creating consumer behavior that just didn't exist before, right? You know, and you know, if we didn't have things like the iPhone, for example, none of these markets exist, right? So there are these precursors in technology that create foundational elements that hopefully over time allow you to kind of grow and expand the markets.
Yeah, no, Josh Baer did a terrific job of explaining yesterday that without an iPhone in your pocket and without the app on your phone, you would never call a taxi to come to this event. But it's very easy, knowing that parking is impossible in Austin, to call a Lyft.
Right.
Or to, you know, of course, order a Lyft.
Yeah.
And let's talk a little bit about product market fit.
Yeah. Okay, so let's assume, right, we think the market's big enough. So then the big other area that we talk about a lot is kind of, you know, there's really two big components, right? So there's kind of team and product market and product itself. Let's skip team for a second if you want. We'll go to product. So the way to think about product, right, is, you know, you've probably all heard this term product market fit, which was, I think, you know, kind of created by Eric Ries, who's, you know, the famous person who created Lean Startup, as well as Steve Blank at Stanford, who invented this. But the fundamental idea is pretty simple, which is, okay, like, what is the fitness between the product and the market? In other words, we have a market need, and how well does this product actually satisfy that market need? And the challenge at the very early stage is, you know, kind of, we can have hypotheses about how that might work, but look, until we get a product into market and actually really understand what happens there, it's unlikely that we will really know kind of whether something has product market fit or not. And so think of it as it is going to be an iterative process. And so what the VCs are looking at when they're evaluating your company at the early stage is not necessarily whether you have product market fit, because it's probably unlikely, you know, that you would have enough data to show that, but what is your thinking around how you decided based on what market feedback you incorporated to build this product? So it's a little bit of the idea maze, you know, in your head as to what they're trying to figure out. And they're trying to figure out, okay, over time, as we get more data from the market, how versatile will this team be? How much will they be able to incorporate that feedback in a way that allows them to kind of ultimately hone in on product market fit? And, you know, ultimately it turns out, you know, with a lot of these technology businesses, that the kind of limit to growth for most of these companies is the ability of consumers and end users to adopt technology. So there's a very famous quote, I think I put it in the book, by a German physicist called Max Planck. He was around in the mid-1800s. And he had an interesting quote, which at the time, which has still proved to be very kind of prescient, which is that technology advances one funeral at a time, which is an incredibly morbid way to think about it. But it's a really good articulation of what happens with technology adoption curves, which is it does often take significant changes in user behavior to adopt new technologies, and sometimes it does require generational changes and generational transitions. I mean, you know, you see it today, right? I mean, you know, kind of this generation, you know, you've grown up with, you know, kind of effectively ubiquitous internet connectivity, and so that will forever change how you think about adoption technologies, and that's different from probably how you and I grew up and how we view this stuff. But I bring it up just because I think, you know, product market fit is one thing. The question then is, can you actually get consumers to change their behavior as required in order to adopt the technology? And that is kind of, you know, almost a second, you know, challenge or a limiter sometimes to technology adoption, even more so than just kind of, you know, kind of satisfying the market need for the products.
Well, certainly my mom wouldn't update her cell phone without one of my kids around.
Right.
So let's talk about the industry evolution. So
Yeah.
VC in the 1970s to VC today.
Sure. Okay, so we're going to do 59 years of history, if my math's right.
59 minutes,
49
59
years of history,
seconds.
sorry. Yes, we'll do it quickly. So look, here's the basic way I think to think about what happened in the business. So early 1970s, particularly in Silicon Valley, is when a lot of the firms that you probably heard of today started. Sequoia, NEA, Mayfield, some very, very successful firms, Greylock. From pretty much 1970s to kind of mid-2000s, it was a pretty static industry. So it was really characterized by three things. One was money was scarce, the VCs had the money, and therefore the VCs had the power. Now that's a very kind of, that's probably a little bit of an unfair way to kind of summarize 45 years of history, but that's basically kind of the way to think about the business. So kind of if you thought about the balance of power between VCs and entrepreneurs, the VCs really had significant power in large part because they controlled access to capital. What really kind of changed and what's dramatically changed the industry starting kind of early 2000s is number one is kind of the cost of developing and starting companies started to fall very significantly.
Yes.
So, right, just every cost, the cost of servers and networking equipment and storage and software and all kinds of other stuff fell by orders of magnitude. Just, a function of Moore's Law really percolating through all the kind of, facets of the industry. That was a huge, huge change. And then the second big change, of course, we've seen, which for those of you who follow things like Amazon Web Services today, of course, about, is that, kind of we moved from a model where you had to kind of purchase through capital expenditures a lot of foundational technology just to get your business off the ground to now kind of pay-as-you-go models where you can
So
do the stuff.
When you think about it, it really kind of blows your mind.
Yeah. And so the big confluence of those two events just dramatically changed this business, and in particular really created the whole kind of seed category in a way that just never existed before. So it never was the case that you could raise $500,000 or $1 million through any kind of traditional institutional means. Sometimes you'd have individual angels who might write checks, but you never had kind of like real institutional seed firms. And today, I think over the last 10 years, there's something like 700 or 800 new firms that have all started in the seed category. And so I think the beauty of that, what it means for entrepreneurship is, kind of the ability to get relatively small amounts of capital to start a business today is way better than it ever was, which I think is a fantastic thing. It allows for all kinds of experimentation for entrepreneurs. Just to give you a quick sense, number of seed deals has grown by about like 8 times. We're doing 8 times the number of seed deals today as we did basically 10, 15 years ago. And it was actually even higher in 2015. It peaked at about 12 times. So like 8 times growth in terms of number of seed opportunities. Now, the challenge is the number of kind of what you would call A and B round, kind of traditional early stage venture rounds hasn't grown at that same pace. It's grown by less than 2x over that time period. So you have this wonderfully huge funnel now of seed opportunities for experimentation, but it does have to funnel into a relatively narrow spigot as you go into these later rounds. So while it's kind of, remarkably easier and cheaper to start a company and get something off the ground, it's still kind of, you got to run the gauntlet to kind of get to that next stage of financing in a way that you can hopefully ultimately come out the other end, with a very exciting business.
Yeah, but you talk about the amount of R&D that companies buy in the book. And so, certainly there are paths if you can't raise your A.
Absolutely, yeah.
Yeah.
Yeah, look, there's no question that, look, a lot, and that's what happens in this business too, in venture, which is, look, a lot of what we fund, even though we all hope and expect at the time we invest in it that it can be an IPO-able company and go public, the vast majority of things in this business get sold, right? So probably, 80% of the exits in this business come from acquisitions as opposed to IPOs. And that's just the reality of it. Look, it's hard to build a company, period, right? And there's no kind of shame or failure in that. And sometimes it's better for these companies to be inside of larger companies where there's greater resources and they can achieve their product visions in a way that, is more sustainable.
And yesterday we were somewhere and you said something that I thought was so interesting because it's so different than the way that I think, which is you thought that the founder is thinking about their exit and their M&A, that makes you think that maybe they're a little bit less. Whereas I, as an angel investor, I'm always like, if we could get bought by, I'm looking at JD from Oracle. If we could get bought by Oracle, that would be terrific.
Right. Right. Well,
So it's very interesting.
Yeah, it's, I think the context in which I brought it up is, look, part of what obviously the venture capitalists are looking for is the expansiveness of your vision, right? And we want we want to believe, as I think you do too, that look, you're going to go out and walk through walls and go build this tremendously exciting and big company. And when you kind of then also talk about kind of, if it doesn't work, we might get acquired, it feels a little bit like a hedge, right? It feels like you might not be completely there. And that's an unfair statement because that's probably it's not true of how all people do. But it's those little things that kind of can, give people pause to say, okay, like, everything sounded great until I got to that point where they're like, that made it feel like, maybe they'd be satisfied with that outcome. And look, we know that that outcome is very likely because that is the path, but we also want to at least believe at the time that we're all aligned around what we're trying to achieve and what we hope ultimately, we can define as success.
No, I
as
love it.
businesses.
So last night at the book signing, there was a wonderful woman who asked about diversity in, and I think you had a beautiful response about the 800 new seed stage. How do we get diversity in the industry? And I think the response was very much.
Oh, thank you.
Yeah.
So look, I think, diversity in the industry is bad no matter what numbers you look at, right? And that's true of, female representation, is true of, broader representation among African Americans and Latinas. It's also true, quite frankly, of geographic diversity. I mean, look, Austin is a wonderful environment where we're starting to see, tremendous growth there. But today, the reality is, look, 70% of venture capital dollars are between the Bay Area and New York and Boston. So we've got diversity writ large is a challenge for the industry. What I was saying last night is I think the good news, and I'm an optimist on this stuff, is if you look at a lot of the new funds that have formed over the last 10 years, which is kind of in this seed area, the diversity of those funds is actually much greater than the diversity of the more traditional funds. So something like, I don't know if this stat is actually right, but I've heard it from a couple different people, but something like a third of the partners at these new funds are women relative to, again, we know the industry writ large is about 10 or 12% today. So that's not to say that, look, that's the end-all be-all solution for the problem, but I think, we are finally having conversations that are helping people, I think, move forward in a constructive way, think about the value of diversity.
And I also think that the world is, like, I love Slack, and I love to do it in an H-E-B parking lot while on my Bluetooth, I mean, I think the world is allowing us to work where we want to work, which I think is allowing those of us who want to have fun schedules
I hope
to
so,
kind of, kind of manage it, and make it all happen.
I think that's probably true, and I think, look, importantly, as I said, it's a conversation that, it was a very hard conversation and look, this is true of a lot of industries, unfortunately, right? Venture is not the only one, but
no, of course not.
I think the good news is, like, people are at least having that conversation now. We're starting to see some progress. It will take time, right? I don't want to be Pollyannish about it, but I think at least we're having the conversations in a way that's constructive and helping people think about how do we improve.
And I love now that we're getting research that, what is it, if women are in management and if women are on our board, the companies perform better. So there's nice statistics now to support these things, which before we simply didn't have statistics.
Yeah, I think that's right. Yeah, most of the research that's come out does show that, in general, diversity of thought and diversity of thinking, and including, gender and ethnic-based diversity in companies does actually produce better business outcomes. And so, look, ultimately, that's good. I agree. That's good data because, look, ultimately, people will kind of skate to where the puck is on that kind of stuff and want to be part of those companies.
Fabulous, fabulous. Well, we're going to switch the topic again, and we're going to talk about the economic cycle. So when I moved to Austin in the summer of 2000, there were cranes all over Austin. And then, unfortunately, an Intel building sat there for years that ended up having to be torn down because the scaffolding sat for so long they couldn't finish building it.
Yeah.
I feel like we're in that cycle again where all the Californians are coming, life is good.
I thought everybody here wanted the Californians to come.
We like the Californians. So where are we in this sort of economic cycle, and how does that impact what you're doing at Andreessen?
Yeah, so you and I have talked about this a little bit. Look, I'll tell you, the very honest answer is I have no idea, and if you surveyed 10 macroeconomists, they would tell you what they knew, but they actually don't know either is the real answer. But that won't stop me from pontificating about kind of what I think is going to happen. Look, I'm an optimist by nature. You couldn't be in this business if you weren't. Look, my fundamental view is if you look at the data that we have today, at least U.S. domestically, if you look at unemployment, if you look at business confidence, if you look at consumer confidence and consumer spend and, kind of interest rates, look, all those things which suggest to do that we're in a very, very good and relatively stable economy. We're not growing. We're not going to grow at 3 or 4%. But like it certainly doesn't feel to me like we are about to go off a cliff in any meaningful way. Now, there are big, hairy, scary unknowns out there, right? Like, are we going to trade war with China, which certainly could impact, those would have dramatic consequences, from a financing perspective for all of our businesses. But, it's very hard. I think in our business, we invest across very long time frames, right? So we're investing today in early stage companies that might not monetize for 8, 10, 12 years. And so I have no idea what the economic cycle will look like 8 or 10, 12 years from now. So all I can do is deal with what I can do today, which is at the very early stage, the honest answer is, look, our job is to invest in super innovative companies. And yes, there will be hiccups along the way if we end up in, macroeconomic cycles. But like, I feel pretty confident that if we invest in a portfolio of, tremendously creative and successful entrepreneurs who are doing wonderful things in technology and they're building fundamentally important businesses, those things will, enough of those will survive that the business will work and will be in good shape. Now, I think if you're investing for the first time at the much later stage today, you are much more tied to what happens short term in the public markets, right? And so I think you have to be careful in that end of the market to really understand, if I'm investing in something today, if the financial environment changed and they couldn't raise more capital, for example, or do something like that, could those businesses still be viable? And so it puts a real premium on what you'll hear people call the unit economics of the business, which is, okay, do you think fundamentally these businesses can work at the unit level? And are we really just spending cash because we're trying to kind of increase market share? And would we be happy in an environment where if we had less money, we could kind of ratchet down sales and marketing, grow at a much slower, more measured pace, but the business could fundamentally sustain itself. So I think that's what you see happening, quite frankly, today in the public markets, is people trying to make those assessments of companies, and that accounts for, I think, why you see companies trading, differently depending upon kind of how much kind of cash consumption people, view as reasonable for these companies.
And we spoke earlier about the mega rounds before IPO. I find that all very fascinating. Are there thoughts that you would like to share?
Yeah, look, the big macro point that we talked about earlier, which I won't go into a lot of detail, is what's really happened over the last 10 years or so is you've had effectively a massive transfer of capital from the public markets to the private markets. So again, the example that I always give, which is very interesting, is so Microsoft goes public in 1984 at a $350 million market capitalization. Today it's worth $1 trillion. So that's, call it 3,000 times growth in the public markets. Facebook goes public at $100 billion. If you did the math and you said, could Facebook grow at that same level as Microsoft, you'd quickly find the math doesn't work, right? It would be just a crazy, crazy number. It'd be like, quite frankly, bigger than probably global GDP today. But the point is a very simple point, which is growth that used to happen in the public markets is now happening in the private markets as companies stay private longer. And so I think you have to think about that, people like SoftBank and all these others in that context of that, which is it's largely, I believe, just a shift of capital and a shift of appreciation from a public to a private market. I personally think that is not going away. I think that phenomenon is
That's here to stay.
I think it's a fairly permanent phenomenon. Now, maybe it shrinks a little bit in terms of time, but I don't think it meaningfully changes.
Is it good for society?
No, I think it's not good for society. And I've had the privilege of being able to testify in front of Congress on some of these things. And I've said the same thing at the SEC too, which is, look, the problem is, it's very good for people who have access to private markets, right? So it's great for people, like you who can invest in seed companies or me or, the University of Texas has an endowment that invests in venture capital. It's great for them because they're able to capture that appreciation. But the vast majority of, kind of regular people in the United States don't have access to those types of investments. And therefore, what's really happened is the growth opportunity in the public market has really been compromised at the expense of the opportunity in the private markets. And there's lots of kind of structural reasons for why that is. But so look, as a societal matter, I don't think it's a good thing. And what we've been talking to, the SEC and Congress about is, look, how could you change that? Are there policies you could do that would encourage companies potentially to go public earlier? Or do you think about how you change access to private technology for a broader cross-section of the universe? And so those are all, I would say, very, very early stage policy discussions that are happening right now. But, kind of just as a kind of member of the U.S. economy, I would much rather see greater distribution of, those opportunities, and I think that would be better for society and, quite frankly, better for global growth.
One of the reasons I would encourage everyone here to read the book is Scott really focuses on some court cases that I find fascinating because nobody else really seems to go into that level of detail. And this level of detail here, I think, would be absolutely fascinating addendum. So the last question before we go to question and answers. So let's talk more. I think it's really interesting that Walmart, for instance, is not going to sell ammunition and e-cigarettes. So business has a role in society. And what are you thinking the VC's role in society is?
Yeah, so more generally on this topic, I wrote about this actually not that long ago. I had a piece in Barron's about kind of, ESG more generally and what's the kind of, what's the role of the corporation. Look, my general view is exactly what you described, which is it's perfectly consistent with trying to maximize shareholder value for a company to also think about constituencies that,
Yes.
maybe outside your direct constituency. And I think good companies have done this for a long period of time. I think our job is, I think we play a role here too. So I certainly think, as we've talked about, look, I think we can play a much better role in increasing diversity and inclusion more generally
Yes.
across the industry. We can also, we have the luxury, I think, also of being able to hopefully forward and invest in technologies that can have societal impact. So, people differ on this. Peter Thiel has this very famous quote, which is, we asked for flying cars and we got 140 characters. And, he's used it to kind of bemoan the state of technology. I actually, we've said this before. Look, I actually think Twitter, or whatever you think of Twitter today, which certainly has its issues, but you can directly trace kind of things like geopolitical change and positive change from an Arab Spring and all kinds of other things that
We're
have
all
happened as a
more
result of that.
informed,
Yeah.
I mean.
So I think generally kind of that's our job, is to kind of have a positive outlook on the role of technology in the world. And, we're doing a bunch of stuff, as you and I talked about, in the life sciences area where, if these companies can accomplish even a fraction of what they're setting out to do, the way that we will kind of diagnose and treat, diseases that kind of, really cripple us today, and how we will think about the delivery of healthcare, all those things are great. We've got a couple investments around, agriculture and sustainability and things of that sort.
Nice.
So I think it's important for us to think about. Now, I will say the one big caveat, of course, is it has to be consistent with our overall mission, which is the primary reason why, a Utimco, by the way, who's not an investor of ours, but why they would invest in a firm like us is because they have to generate a certain rate of return to be able to support, obviously, their activities here. So we can't do it in a way that compromises returns. And again, I think if we do it smart, there's no reasons why that has to be. I think we can both do good and do well, and also kind of, financially kind of meet the obligations that we have.
Absolutely. Because just to close out, the
Yep.
statistic in the book, what percent of innovation R&D, it was a big percent of U.S. R&D.
yeah.
It was like 40% or something.
Yeah,
you said.
yeah. If you look at, Stanford did this study, if you basically look at kind of venture-backed companies, something like, 44% or something of all R&D in the U.S. is being supported by, often now public, but originally venture-backed companies. So look, venture is tiny in the scheme of things in terms of the number of dollars, but the impact of venture, I think, as these companies grow, and look, the top 5 largest market cap companies today are all, venture-backed companies originally. So, I think there is good that we can do in terms of job creation, economic growth, and sustainability, and, inclusion and diversity, and all kinds of other things. And, the industry can have an outsized impact on the world, and I think it's incumbent upon us to make sure that happens.
Absolutely. Well, I know. That's absolutely fabulous. Well, we are going to form 2 lines with questions, and please come. We'll do rapid fire.
All right, we'll be quick.
All right. And we have about 15 minutes, so please go ahead. And we'll just rotate.
All right, you guys look like you're ready first. We'll go here.
Thank you. I appreciate it. So one thing that you mentioned is that there's a lot more capital in private markets.
Yep.
The VC industry has become a lot more institutionalized. How do you see that affecting the future of VC?
Yeah.
And how do you try to avoid, kind of a monolithic mindset and keep that innovative spirit in your company?
Yeah, it's a good question. So for people who didn't hear the question, we talked about kind of availability of capital and, what's happening in the industry, and how do you avoid kind of the industry becoming kind of a monolith. Look, I think the good news is it's the most competitive this industry has ever been. And so, the number of new firms being formed, the amount of capital, it's really forced VCs to kind of up their game and realize that capital alone is not a differentiator anymore in this business. So capital, there's always going to be someone out there who's got more money than we do, who's got a lower cost of capital. And so it forces us, and look, for us at Andreessen Horowitz, this is kind of why we built the business. It's forced us to think about what else can we do to help entrepreneurs. So I think in that respect, it's an incredibly entrepreneur-friendly, kind of path forward that we've had for the VC industry in that sense, is that entrepreneurs have way more choices than they ever had before. Look, I think the way, the business, as for all the business has changed, the fundamental thing hasn't changed, which is our job is to find super innovative things that people are doing, and hopefully, kind of give them as much running room as they possibly can, and at various points in time, try to be helpful and valuable to them along this journey. And so, I think as long as we stay true to that mission, I think the industry, kind of, has a long future.
Yeah.
Thank you.
Talk really quick about those voting class shares, the entrepreneurs. I thought that's super fascinating.
Oh yeah, you see a big change. You see governance changes, in this industry a lot, and so you do see more companies where the founders are controlling the companies in ways that they just did before. Look, it's playing out obviously in very public fashion now when you look at things like WeWork and others. But it's an important governance change that's happened in the industry, and I think again, generally been very favorable from an entrepreneur perspective in terms of their ability to kind of have long-term guidance and control over the companies. Yep.
Scott, thank you so much for being here.
Thank you.
And thank you so much for writing the book. As an entrepreneur, there's very few times where a book so important comes out where we really can demystify
Well, thank you. I appreciate that.
Process. My question to you is, you talk about in the book the importance of storytelling.
Yeah.
You talk about the importance of having those market size that are worth pursuing. My question to you is, what would your advice be to entrepreneurs who have the potential to get big, the market size, but they understand that the road to get there is long, and that they need to focus on a chapter 1 before they get to a chapter 10? What would be your advice?
Yeah, great. So look, I think that's perfectly fair and reasonable, and it's actually endemic of lots of businesses, right? So we talk about this sometimes, which is kind of, are you investing in a multi-stage rocket, right? And so I'm not an astrophysicist, but for those of you, I'm sure there probably are some in this crowd, but my very basic understanding is, look, oftentimes, you kind of need multiple rocket boosters to get into orbit, right? You need kind of a first booster to probably hopefully get you off the launch pad and through most of the Earth's atmosphere, and then you need that second rocket booster to get you into whichever atmosphere you're going to after that, which is the full extent of my astrophysics knowledge. And so I think that's true. So I think you just need to explain that, right? So it's perfectly fine to say, hey, look, and you could feel free to use my two-stage rocket, analogy. I haven't trademarked that, but I think that's okay, and people understand that. So I think what people, I think people would worry about is, okay, is your thinking expansive enough so that you can ultimately get to that market? But yeah, look, there are many markets where you have to do that. I'll give you a great example. So we were not an investor in this, which was a mistake, but Square is a perfect example of a two-stage rocket, right? So for Square to be successful, their first business was the dongle, right, which is, kind of literally the credit card reader. And the honest answer is that's not that exciting of a business. If you look at it from an economics perspective, it's very, very low margin, right? It's a couple basis points of margin business. But their theory, which Jack well articulated, was if we own that part of the business, then we will own the customers to a point where we can then offer all kinds of ancillary financial services to them. And that's a really exciting business because now we've got, not 2 basis points, but we've got, hundreds of basis points of product. And so just, helping people understand that, explain that, I think is the way to go.
Yeah. Thank you so much.
Thank you. Yes?
Since you mentioned WeWork and the whole mega round
Did I say
thing,
WeWork?
with the difficulty a lot of companies have faced since IPOing recently, do you think private valuations may have outrun what the public market is willing to bear? And if so, do you think that'll drive a shift in the industry?
Yeah. I've said this before publicly, and so I'll say it again in this forum. I think it's very dangerous to kind of to interpret too much from the WeWork situation on what the impact is for the broader market. I think WeWork is very much a class of one right now, which is, it's got lots of complicated issues, and I'm not defending WeWork, by the way, but you've got a confluence of, number one, some very unusual governance structures, and notwithstanding the fact that we've had, there are some different governance structures, period, in the industry, it's definitely still even unusual compared to some of the changes that have happened in governance. Number two, you have a company that, despite its growth, is still consuming lots of cash, and just because we are, what people perceive we are in a later stage market where, and you see this in more volatility in the market, high cash consuming companies generally are, a little bit more, focused on. And then you've got this more foundational question, which is the third piece, which is, how do you value this business? Is it a technology company, or is it fundamentally a real estate business? And those are real and valid questions. And so my personal view is, look, I think WeWork is a bit of a class of one. There's a more general question, which is what's happening in some of these things. It's actually the case, interestingly enough, that there's been more convergence between public and private valuations over the last couple of years than there was in the prior, kind of 3 or 5 years. And so, we saw fewer companies going public at values below their IPO price over the last couple of years than we did in kind of the 2015, 16, 17 timeframe. So that's a positive thing to a certain extent. The problem that you have with all these things is you have to remember the big foundational difference is in venture capital and private markets, you're talking about episodic valuations, right? There are points in times at which we value these companies, and it's not a continuous market, okay? So what I mean by that is if I like Apple stock and you like Apple stock, we can both go buy it tomorrow. It's not winner take all. We both have that opportunity, and it's continuous, right? Which is, look, like you could change your mind tomorrow and you could sell it, and the market kind of updates that pricing. You know, if you invested in, let's just take WeWork, if you invested in the last round of private financing for WeWork, there was one time to do that. It was at a predetermined price that was negotiated, and you were making assumptions about what the future would look like, knowing that it was going to be a discontinuous market, that you wouldn't have probably another period of time for maybe 12 or 18 months to do it. And so that just introduces a lot of the, you know, uncertainty that we do see in some of these things. So anyway, so long answer to your question, I actually feel like we're in a, you know, I think we're in a relatively healthy market in the sense that the market is discriminating between things that are doing well and not doing well. It's giving premium valuation to companies that are doing very well, and it's punishing companies that aren't doing well. And so I think that's actually a well-functioning market.
Thank you.
Yeah.
Are there any specific red flags you would look out for when putting together a round composed of both financial investors and corporate venture capital?
Yeah, great question. So corporate venture capital, by the way, has become a really important kind of increasing participant in the market. So they were, you know, for most of the history of venture capital, there were always a couple, but I think the data I saw, something like 25% of financing rounds now have a corporate partner there. The red flag, so and they're very good partners, and so I think for the right companies and the right times, it makes sense. The big red flag to think about is, are you putting yourself in a situation where you might be effectively kind of what I would call selling the company to that corporate without actually having achieved an economic premium to sell the company? And what I mean by that is, are you giving them too much ownership or too many rights that might then cause other potential acquirers down the future to say, hey, look, I'm not even going to bother looking at that company because I know corporate X has a blocking right, or they own so much of the company that if I bid, they're just going to outbid me. And so you just don't want to put yourself in that situation. So I think corporate venture capitalists are fantastic, but just be careful that, you know, you think about, okay, am I doing something that could compromise my degrees of freedom down the road that would cause other potential partners to not be interested in the company? And I think there's pretty good tried and true ways to avoid that now. So I think it's very manageable.
Nice.
Thanks. Yes, sir.
Hey, good afternoon. Thank you for coming today. This is for both Andrew and Scott. I'm a fourth shift entrepreneur because the first three are dedicated to my current job. So my question for you is, there are many articles and books out there that talk about the importance of teams. As an angel and as a VC, can you talk about how important and imperative the team is, even if it's a team of one? Like, how important is management?
Yeah.
Team is everything.
Yeah. I think that's the answer.
What are you looking for?
Yeah.
Like, give me some attributes that help you identify the team.
Well, you were talking about how sometimes you have to change and be flexible.
Yeah, here's the way I would think about it, right? So if you go back to first principles, right? So assume you're going after a big market. What do we know about big markets? They're going to be competitive. There's going to be lots of players. So the real question then for a venture capitalist is, why invest in you versus anyone else who might come into the office with the same or similar idea? And so that's what we're really trying to figure out is, what is it that's unique about you? What do you know that's different that someone else knows? How do you know that? That's kind of one aspect of it. Some of it is just, you know, your team building and leadership skills, right? So why will people do a crazy thing like quit their good paying day job to come work for you, you know, in a startup? Like how compelling are you as a storyteller, as a leader, as a visionary? Because you're going to need that skill to recruit employees, to go find investors, to go find customers. All those things. And then look, there's the kind of intangible of, you know, how badly do you want this, right? We know, look, the reality is the track record is most of these companies don't succeed, right? And so there's going to be times where, you know, my partner Ben Horowitz wrote this book called Hard Things About Hard Things, and there's a funny line in the book where he says, you know, when he was a startup CEO, he slept like a baby, which means he cried all night long. And that's basically kind of the way to think about it, right? A startup is a series of near-death experiences, and the question is, can you survive those near-death experiences? And so I don't want to overstate it, but I mean, that's why team is so important, because look, markets may change, products may change. I'm not sure people change at the end of the day that much, and so like, so much of what we're investing in is your ability to navigate through uncertainty over time, and so helping us understand who you are as a person and what makes you kind of, you know, capable in that area is really important.
I thought what you said really this morning about winding down and how sometimes entrepreneurs are, you know, sometimes when the company's not going to go well.
Yeah, we were talking this morning in this earlier session that, look, you know, it's unfortunate, but, you know, we know it's the reality is, look, a lot of these companies just don't succeed. And sometimes, you know, you kind of, as a VC, right, you're kind of nervous to have that conversation with the entrepreneur. What I've found oftentimes, though, is that it's often sometimes a relief to the entrepreneur to have that discussion, because often they are thinking the same thing that you are, which is, look, for nobody's fault, this business just isn't going to be what we thought it was going to be. And many times I hear the entrepreneurs say, look, I was sticking through this because I thought you wanted me to stick through it. And look, of course, we don't want you to, quit all the time when the going gets tough. No. But like, there is a point in time at which, look, it just doesn't make sense anymore, and it's better to have that conversation, which is, look, despite our best efforts, like we don't find there's not a viable way here, and let's go figure out a rational way to move forward. We'll go to this side, yeah.
Thank you so much for answering my question. Quick question is, if you're an entrepreneur or a VC, like what are the landmines to avoid, and how would you invest in a product when you're so young?
I'm sorry, say it again. If you're an entrepreneur, what was the question?
Or a VC, what are the landmines to avoid?
What are the things to avoid?
Yeah.
Look, I think, let me take it from the VC side, right? So if you're a VC, like there's basically two mistakes you make in this business. There are mistakes of commission and mistakes of omission. So commission is you invest in a company, it doesn't work. That's no fun and nobody likes that, but look, that's the reality of life and that's okay. The bigger mistake is the mistake of omission, which is you talk yourself out of doing a deal that turns out to be the next Facebook or the next Google or something like that. And so I think you just always have to think about that in your mind, which is making sure that you are appropriately balancing risk in that way and looking for things that can be outliers and not shying away. Look, as an entrepreneur, I don't know what the mistakes to avoid. Look, the biggest mistakes to avoid, let me answer it this way, which is the biggest failure case that I see with our companies is not like the product didn't work. It's often the kind of managerial and growth-related aspects of the business, right? People don't hire executives at the right time. They don't think about their go-to-market the right way. They end up wasting time on things that don't make sense. And so I think we all think about product, which is incredibly important. That's great. The reality, I think, is there's a difference between building a good product and building a good company, and it's often those things that tend to be the difference between success or failure.
Yeah, so I grew up in Silicon Valley, and a lot of pundits sort of talk about like the bubble or like the mindset of living in Silicon Valley. And additionally, you talked about the geographical constraints of like venture capital and where the dollars go.
Yeah.
So how do you see like the VC firms sort of shifting away from this and targeting companies that may not be like located in ideal locations? Like Facebook had to move from Cambridge all the way to Palo Alto to sort of pick up and gain the like founding and funding that they have right now.
Yeah, it's a great question. So look, I mean, looks for all the wonderful things Silicon Valley has, you're absolutely right, which is, look, there's plenty of problems there, and you know it from being there. Look, we've got housing, affordability problems, we've got transportation problems, we have education problems, we have tax problems. So look, I mean, we can romanticize it as much as we want, but it has issues. Now, it also has, on the positive side, it has this network effect of relationships that's built up over probably at least 70 years, like, going back to certainly the military-industrial complex, and some might argue going back all the way to the founding of Stanford University, where you had kind of professors and, kind of going in and out of academia and commercial opportunities. So I think it has problems. Look, my general view on markets is you need early stage kind of seed-based capital to be local capital, because it's very hard for people to get on airplanes and, do stuff in seed. And so, as I was saying, a bunch of people here the other day, look, I don't know this market very well, but like I'm encouraged by the fact that I think there is a very robust seed ecosystem here, because I think you need that. I think capital above that is fairly efficient in that people will get on planes, and so you don't have to have, per se, an Austin-specific Series A, B, C, D round of companies. There are companies who may do that, but I think that capital is much more efficient. So I'm pretty optimistic about what I think will happen. I don't think Silicon Valley, at least not in my professional lifetime, I don't think it's going away, but I do think we will. I think there's reason to believe that we ought to have greater geographic diversity, and I think, again, places like here are great candidates for that.
Absolutely.
Yes, sir.
Hello, thank you for being here. So you make a claim in your book that when you are investing in an organization, that you are theoretically placing a bet that that organization is going to dominate that market. What is your view about investing in other companies that are challenging the fundamental innovations or the business models of your pre-existing portfolio companies?
Yeah, it's a good question. So look, the reason we focus on we are looking for that is the reality of most tech markets is they tend to be not necessarily winner take all, but winner take most markets, right? So there's often very disproportionate market share between the top one or two players in markets relative to the next 3 or 5. So that's what we're trying to get to. In general, though, as a VC, it's very hard to invest in a company that is, it's very hard both reputationally and quite frankly, you shouldn't be doing it, to invest in companies that directly compete with one another, right? So, we're an investor in Lyft, like, even if we had wanted to, like, we could not have invested in Uber, right? Because you have this brand affiliation that comes with it. It doesn't make sense. The challenge becomes more, to your point, look, like, I don't know what a good example would be, but, if we were an investor in Salesforce.com and now we're no longer an investor in it, could we invest in something that might challenge them? Look, I think the answer is I think that's perfectly fair and reasonable, which is, look, if you're no longer on the board or actively, kind of investing in that company, I think it's fine to kind of challenge incumbents along the way. And I think that you probably do see that in this business. So, you have to be careful about direct conflicts, but I would say something like that where you've really kind of, are really no longer active at all in the company, I think those are much less risky.
Thank
you. Yep.
But I did think in the
sorry.
book you did a really nice job of laying out conflicts of interest,
Yeah.
specifically with the board.
Yeah,
And I
no,
found
it's
that
a critical,
very
it's a critical
interesting.
issue for sure, yeah.
Thanks, Scott, for being here, and thanks both for the discussion so far. My name's JD. My question is, we rarely hear from folks that operationally run these types of firms.
Yeah.
And so I was wondering if you could just lift up under the hood a little bit and give us some insight into what fires you battle every day and challenges that you see, not so much on the investing side of things, but...
All right, yeah, I'll give you two seconds on that one, even though you're the first person who's ever asked me that, so that's good. Yeah, look, I mean, basically I think of my job as like the firm, we have to function as the business of venture capital. So think about what that means. Okay, so we have to have money to be able to do stuff. So I spend a lot of my time talking to investors and raising capital or making sure the investors understand what we're doing. So hopefully when we're ready to raise capital, they give us money. We are also, just as a firm, we've got 180 people. So there's kind of just a day-to-day general management job, which is, look, like we have to make sure people know what their objectives are and how they're being measured and how they progress through the organization. A lot of it goes to that last, the question I think that Andrea had alluded to, which is, how do we prioritize our resources? So we spend, we can't be all things to every company at all times. And so we do, unfortunately, have to kind of decide, are we spending more time on this company or not? So a lot of it becomes that. And then a lot of it to me is making sure that we are measuring and focusing on the right things. We talk a lot about it in the business, which is it's very hard to kind of measure outcomes because in this business, you can learn the long lessons sometimes from outcomes. Because sometimes the reality is, look, sometimes companies fail, and you would probably make that investment again, even if you knew that it might fail, because like you're trying to measure the process of looking at the company. And sometimes companies succeed, quite frankly, despite us doing anything brilliant at all, right? And so, you can very easily either learn the right lessons about being too risk averse on the ones that fail, and you can also overinterpret your own brilliance and success when companies succeed, because the reality is, look, we don't build these companies, right? The entrepreneurs build these companies. So that's a lot of also where we try to spend our time, is kind of making sure that we are refining our processes in a way that we're doing things well, that doesn't hopefully confuse kind of all these variables that can impact outcomes that we just can't control.
Mm-hmm.
Thank you.
This will be the last two.
All right, last two, yeah.
Hello,
Hi.
my name is Charlotte Hayden. I own a local simple syrup business,
Oh, nice.
and I've been approached by accelerators as well as venture capitalists.
Yeah.
And I'm trying right now to decide if I want to go the accelerator route or I want to raise a seed round. And
Yeah.
I'm wondering if you have an opinion on which one you would prefer.
Yeah. I mean, look, it's hard to give you advice without really understanding your business. But look, I guess I would think about so to me, the question is, like, on the accelerator side is, accelerators are fantastic, but obviously, you're going to give up equity, obviously, often for these places as well. So to me, the answer to the whole question is the same, which is, where do you think you're going to get the most value to help you build your business, right? So, like, are there areas you feel like you need help that you're not getting help? What else besides capital might be relevant to you in your decision-making? And again, I don't know your business well enough, but I would make the decision on that basis, which is, okay, like, it's going to cost me X percent to go the accelerator route, it's going to cost me Y percent to go the VC route, like, do I believe, ultimately, what is my real cost of capital, right? What am I getting from them that justifies, that? And I think you can, I would just kind of think about it in that framework.
Mm-hmm. Thank you.
Thanks. Yeah. All right, last question.
Thanks for hanging out. My question's more about, since pretty much, arguably, a lot of this room is not the technical co-founder side of the business, what skills are like not negotiable, have to bring to the table to be, on the business side, valuable to the technical co-founder, right?
Yeah, that's a great question. So, obviously a lot of it depends on the type of business you're in. But look, I think non-technical co-founders play a very, very important role. And I think, where I think you can add a lot of value is particularly around go-to-market, right? So what is the go-to-market motion for the company? How are we going to sell? How are we going to market? Who's our target buyer? How do we, develop efficient processes for doing that? I think a lot of non-technical co-founders also find that they like and enjoy kind of the operational aspects of running a business, right? So just kind of what we just talked about, like, how are you managing people? Do people understand their metrics? Do they understand how they're getting measured? Are you doing a good job at communicating kind of the mission of the company and things of that sort? And then look, a lot of non-technical co-founders also can be very effective on the capital raising side of things, right? To help kind of bridge the gap a little bit between kind of, you know, the vision of the product founder with, okay, like, what are the nuts and bolts of how ultimately this business will roll out? How will we make money? What does the business model look like? And those types of things. So look, I think they're a very, very important part of the ecosystem, and you know, I think there's lots of places to add value.
Yeah. Thank
Thank you.
Well, we're going to wrap up, but
Thank
I
you.
just wanted to share that, you know, one of the reasons I love to be on campus is because it makes me feel youthful and it opens my mind to wonderful things. And I think this discussion today has actually over the last 24 hours during Austin Startup Week has really been so beneficial in opening our mind, understanding your journey. I encourage everyone to read the book because we do get a lot of rah-rah in Austin about, yay, entrepreneurship is fun and VC's cool. But very few people dig into the terms and the economics and the governance, and those things are so important. So thank you for being here in Austin and sharing your time with us. We've enjoyed having you.
Great, thank you, and thanks for having me. Appreciate it.